So welcome to CIM MES discussion group presentation featuring Stuart Bergman, Vice President and Chief Economist for Export Development Canada. Today is March 31st and his presentation is entitled Global Economic Outlook 2023. My name is Carlos da Costa, Chair of MES, Management Economic Society, and with me is Jackie Allison, past Chair of MES, and she's going to help me in navigating through today. So first things first, we'd like to give you a few words about who CIM is. And MES is a society within CIM. And CIM is basically is Canada's leading professional association for minerals-related industries with 11 technical societies and more than 30 local branches across Canada and overseas. MES is actually a society within CIM, and MES actively works towards furthering education in mineral management and economics. We use our funds that we raise through various initiatives for educational initiatives and programs in mineral economics across Canada in universities and other academic institutions. Our guest speaker is Stuart Bergman. As I said, he is Vice President and Chief Economist of Export Development Canada. Stuart is responsible for overseeing EDC's economic analysis and forecasting and global markets intelligence and corporate research groups. And EDC is Export Development Canada. For those of you who don't know, EDC is Canada's EDC is Canada's export credit agency and state-owned enterprise wholly owned by the Canadian government. And its mandate is to support and develop trade between Canada and other countries and help Canada's competitiveness in the international marketplace. So without further ado, I'm going to let Stuart take over. Bear with me for 2 seconds.
Okay, great. Thank you, Carlos.
Welcome.
Are we good?
Yeah, we're good.
Yeah. Okay.
Oh, one more thing. I do apologize. For those who have questions, feel free to input those questions in the chat box, and we will definitely answer those questions. Well, actually, Stu will answer those questions at the end of his presentation.
Perfect. Yeah. Thank you, Carlos. Happy to answer questions, engage in conversation. For me, personally, that's the most important part of the presentation is rather actually engaging in this kind of back and forth where I personally find that I learn the most and I get the most ideas for these presentations that I do. But as Carlos says, I'm the Vice President and Chief Economist at EDC, so I am an economist by trade. Please don't hold that against me. And I'm going to start off with maybe something that you don't often hear an economist say. So I want you to listen very carefully because you're not going to hear this very often. But we were wrong. We were wrong. Right? Now, economists, we don't like to talk that way. We like to talk. We like to say a lot of things. But one thing we don't like to say is when we were wrong. But we were wrong. And anybody that tells you any differently isn't being entirely truthful with you. Right? 2022 was supposed to be the year that the global economy recovered from the COVID shock. We came into 2022 thinking that it would finally be the year that we'd be able to put the COVID-inspired downturn behind us. And so even through much of the first quarter, most economists expected that by the end of the year, you'd see the US, Europe, China get back to the paths that they were on before the pandemic. And so if you would have looked at what we call the consensus forecast, last year this time, well, I guess back in January, the end of January of last year, you'd have seen that most economists were expecting the global economy to grow by more than 4%. 4.1% was the average, as I say, the average consensus forecast for the global economy. The IMF, well, the International Monetary Fund was just downright bullish. They were calling for the global economy to grow by almost 4.5%, 4.4% to be precise. Now, in case you think I'm here shaming the others, we weren't that far off, though perhaps not as ebullient as our friends over at the fund. In fact, the biggest risk we identified was that the global economy wouldn't be able to keep up with the pace of growth. It wouldn't be able to keep up. There'd be so much growth, we wouldn't even be able to keep up with all the growth. Inflation, labor constraints were our biggest concerns, because remember that in response to COVID, governments, central banks from around the world unleashed this wave of massive and unprecedentedly coordinated public stimulus measures, right? Interest rates were cut to basically zero, even below zero in some below zero interest rates. And think about that. Central banks loaded up their balance sheets in efforts to pump huge amounts of liquidity into the system, and the world's wealthiest governments launched these enormous fiscal stimulus packages. In fact, by some measures, fiscal and liquidity support out of advanced industrialized economies alone amounted to some 20% of global GDP. 20% of the global economy shoved back into the system in a very short period of time. All right, but because we were in lockdown, there are actually less ways that we could spend that money. All that money that used to go into leisure and hospitality services, into transportation, was either put away for a rainy day, and remember that, we're going to get back to that rainy day fund, or went into ordering more stuff online, right? I like to say that we didn't stop buying, we just changed what we bought and how we bought it, right? So for example, think about how many of you converted your annual vacation into a new backyard deck, right? Very popular question here in Canada, or the daily commute to the office into a technology upgrade. So we basically went from 0 to 100 on the good side in a very short period of time, and good suppliers just simply couldn't handle it. And so while pricing pressures were both certainly a demand and supply story, if you actually looked at all the supplies, and take the United States, for example, if you looked at all the supplies, including domestic supplies, supplies coming from abroad, we were actually 5% above where we were before the pandemic. 5% above where we were before the pandemic. And that was the case when you looked at goods. It was the case when you looked at commodities. It was even the case when you looked at ships. So all the talk at the time, the ships, we don't have enough ships. Where are all the ships? We had the ships. The ships were just parked in all the wrong places, right? The shipping companies weren't accustomed to these new patterns of demand that we had set ourselves. Because if you looked at the demand side, while supplies might have been up by 5% from before the pandemic, if you looked at the demand side, as you see in this slide, demand was actually up by more than 20% from before the pandemic. And so I'm not saying that supply wasn't an issue, it certainly was, but most of the imbalance was driven by this incredible surge, this incredible artificial policy-induced surge in demand. However, we believed that as supply chains caught up, right, as supply chains got used to everything, as interest rates went up, that supply-demand imbalances would sort of ease, and that would bring pricing pressures back in line, and inflation would start to come back down to target. And it was about that time that you start to hear all these brilliant economists all over the world introduce a new term into the global discourse, into the dinner table conversation. You see it here, transitory, right? Transitory. Don't worry, it's all going to be transitory. You ask, well, how long is transitory? Well, we're not sure, but it's all transitory, right? It's going to take care of itself. Even today, with inflation starting to come down in some markets, you have economists that are pointing to that and saying, see, we told you it was transitory, right? 2 years later. Well, next slide, please. Well, what a difference a couple of years made, right? China saw its largest COVID case count of the entire pandemic only in the fourth quarter of last year, causing almost 3/4 of the country's largest cities, including Shanghai, by the way, to impose some sort of restriction, right? Shanghai, major manufacturing, a global manufacturing hub, home of the world's largest container port. In fact, at one point, more than half of the country's economic output was being restricted in some form or another. And with millions of people contracting COVID every day since the government has sort of turned away from its zero COVID policy, its zero COVID approach, and, you know, mortalities in the range of cumulative mortalities in the range of what, 600,000-700,000 or some of the estimates. There are some concerns that we may not necessarily be out of the woods on this thing yet, at least in the Chinese context. Next slide, please. Additionally, as you well know, almost exactly a year ago today, after 77 years of relative peace and security in Europe, the Russian forces of President Vladimir Putin breached the sovereign territory of Ukraine, launching a full-scale military incursion into the Eastern European economy in what was probably the most telegraphed war in all of military history, right? And as a result, we start to move from what economists like to refer to as demand pull inflation, right? Inflation fueled by demand, this artificially induced demand, to cost push inflation. Because remember, aside from the unspeakable human toll that the war continues to take on a daily basis, and that's sometimes lost in, the media's chasing of the new sexy stories, but lives are still being lost there. Aside from that, remember that Russia is the world's largest grains exporter. And together with Ukraine, supplies about 30%, a little bit less than 30% of global wheat exports, 17% of global corn, almost half of the world's sunflower oil exports. The story gets even more complicated in that much of the Ukrainian crop that you see here is certified non-GMO. So replacing that lost export capacity becomes an enormous challenge for the global economy. And remember, grains don't only feed humans directly, they're also used in animal feed. And so whereas food costs were increasing even before the war, even if you look to early 2021, even late 2020, as a result of these changing consumption patterns, right? People not going to restaurants anymore, buying their groceries, buying their food at grocery stores. The invasion triggers even more pricing pressures, with the price of wheat, corn, beef, soy, all well up. Now, prices have come back down a little bit since, certainly since the summertime on concerns around global demand. But next slide, please. We don't really expect further relief, at least over the next little while, given that damage to agricultural lands and the displacement of labor, both in Russia and in Ukraine, have almost certainly disrupted planting ahead of this year. What's more is that as the harvest is currently is done in this very critical breadbasket of the world, those farmers, those producers who were still unable to ship their product are going to have a really hard time financing production next season, especially if input costs stay at currently elevated levels. Because remember that between Russia and Belarus right there, that's 40% of the world's fertilizer supplies. On the industrial side of things, Russia and Ukraine, between the two of them, are responsible for almost half of the world's crude iron exports used in steel production. Russian slab steel is then sent to Turkey, sent to Italy, sent to Mexico to make sheet metal parts. Russia also is responsible for 40% of the world's palladium, 30% of the world's titanium, is a key nickel producer, the third largest exporter of coal, the world's largest exporter of softwood lumber. I mean, you can go on, but there's very few industries here that have been unaffected, untouched by the pricing pressures, right? From agriculture to autos, from aerospace to clean tech, construction to communication technologies. But much of the focus these days, and it makes sense, much of the focus these days is on energy. Again, it makes sense. Russia produces or is responsible for about 12-13% of the world's oil production, about a fifth of global natural gas production. And while from the very beginning, we did not expect a swift resolution to the situation in Ukraine, we expect that there is going to be this continued stalemate, this ongoing war of attrition. And I'm happy to talk about it a little bit later, but we don't see much of an exit ramp at this point, which presents a significant risk for the global economy. We don't see an exit ramp at this point for President Putin. So we don't expect a swift resolution to the situation. Prices have fallen back, certainly on the energy side, again, around concerns with respect to global economic activity, with respect to global demand. Of course, we had the unseasonably warm temperatures, which I'll talk about as well, particularly in Europe, which have helped bring prices back down a little bit. But again, the IEA expects that global oil demand will exceed its pre-COVID peak of 100 million barrels per day sometime this year, right? And maybe even touch a new record, 102, 103 million barrels per day, thanks to fuel switching from gas to oil. And of course, we expect continued demand, continued pressure on oil demand if we start to see the effects of this Chinese reopening that we're talking about. We still haven't really seen the full effects of this reopening, but we very much expect that this is a potential upside risk to our forecast, certainly would present an upside risk from an oil price perspective. And so this is obviously not welcome news for central banks, because as far as I know, while higher interest rates can certainly help choke demand off, central bankers can't pump more oil or plant more wheat for that matter. Now, Russian oil is continuing to find its way into global markets, obviously at a very steep discount, and other producers, including Iran, Libya, Venezuela, will add to some marginal production as well. Additionally, we believe that OPEC's what we call their Goldilocks band, right? So not too low, not too high. Their Goldilocks band for oil prices is probably around $100 a barrel. And we now know that Saudi Arabia is more than willing to manage supplies in order to get us closer to that target range. But we expect oil to continue to be in for this period of extreme volatility, with prices increasingly disconnected from supply-demand fundamentals and more driven by headline risk and the disruptive levels of liquidity that are still sloshing around in the system. And I'll touch on that as well, because keep in mind that the paper market for crude, so when I say that, I mean, oil futures, is 50 times the size of the physical market. 50 times the size. I mean, so you got to ask yourself, what's driving prices here? Is this really a fundamental story? Is this a story of supply and demand? Or is this more of an investment story, an investment play? So when we throw all those forces together, we have a forecast. And I need to caution you on this one because we are in the midst of writing, coming up with our winter forecast. And so we're still working off of our fall 2022 forecast. But, we expect to see some difference, some deviation. Largely, the forces that are in play now were in play in the fall when we came up with our forecast. So we expect to see we forecast oil WTI fall from what was an average of about $95 a barrel last year to about $82 a barrel in 2023. So that would imply still that there's some room for upward movement from where prices are currently, but that will help serve as a bit of a moderating impact on core prices, and we'll talk about inflation as well. On the natural gas side of things, you can see that U.S. natural gas prices haven't done anything near as crazy as what we've seen happen on the European side of things. Irrespective of that, we believe that increased LNG shipments across the Atlantic and lower than normal inventories are continuing to support LNG prices. U.S. natural gas prices put a bit of a floor under U.S. natural gas prices. We're calling for U.S. prices, so prices on the Henry Hub, to fall from an average of what was likely about $644 per million BTU last year to $530 per million BTU in 2023. Again, as I say, this is our fall forecast. Certainly, there's going to be some change to that, but largely we see the dynamics moving sort of in similar direction to what we saw in the fall. So next slide, please. So what does all this mean for the global economy? That's kind of the commodities backdrop that we have behind our global forecast. Well, being closest both geographically and economically to Ukraine, Europe's economy is obviously most vulnerable thanks to immediate risks to critical energy supplies, impacts on inflation, and strains on both business and consumer confidence. Now, we believe that Europe may have really dodged a bullet here. And while, Europe did dodge a bullet as a result of these unseasonably warm winter temperatures that they received, I mean, we're talking about a 3 standard deviation warm winter. So it gives you some sense of how out of the ordinary this winter was in Europe. But the fact that our economic outlook is based on the weather also gives you a sense of sort of how precarious the economic environment is in this part of the world. Nonetheless, while we believe that Europe may have really dodged a bullet here, structural energy security issues remain in Europe. Remember that before the war, Russia supplied 40% of Europe's natural gas supplies, much of which actually went through Ukraine, which was also a point of transshipment for Russian oil, with about 250,000 barrels of Russian oil per day moving through Ukraine, ultimately destined for the European market. Now, keep in mind, this year, that all turns to zero, right? And so again, serious structural energy security concerns remain, and winter's not over yet. And so Europe could still face a fragile couple of winters ahead, where any inclement weather would lead the continent to run down already limited supplies, obviously also pushing up prices. Additionally, I will say that chronic gas availability issues will perhaps deter production in energy-intensive and specifically gas-intensive industries, maybe cause some of those industries to have to relocate to where gas is more plentiful, or at least where gas comes a little bit cheaper. And so Putin's manipulation of the gas market, exacerbated by last summer's drought conditions in Europe, which caused hydropower production to decline by 26% on the continent, have kept really, really heavy upward pressure on energy prices. In fact, wholesale electricity prices in Europe, as you well know, skyrocketed as a result of the fact that they're pegged to natural gas prices. Whether or not the electricity is sourced from natural gas, the prices are pegged to natural gas prices, which is certainly something that European regulators are going to have to sort out once we're out of the current crisis. But this certainly is impacting countries like the UK, where household production is much more reliant on natural gas. It will hit countries, especially like Germany, the region's industrial engine. And so we expect inflation and we have for a while now expected inflation in Europe, in the UK, already pushing double digits, to stay higher for longer. And, much of the market started to turn as we started to see some more welcome inflation figures coming in around the world. Our feeling was, no, there's still scope for some of these upward pressures, and we saw it with release of inflation data in Europe today. Inflation data from Germany released yesterday. Still, there is still scope for upward pressure on inflation. Again, we expect inflation to stay higher for longer. That's going to cut into consumers' wealth in Europe and their ability to spend in that market going forward. Next slide, please. At the same time, all of this uncertainty is making consumers less willing to run down the savings that they've accumulated over the course of the pandemic and make businesses more cautious about spending on investment, spending on production. And in fact, that's exactly what businesses and consumers are telling us. And you can see that right here. Now, the little upswing that you see at the end there is as a result of these warmer temperatures. Like winter wasn't as cold as we expected. And so we start to see an upswing in confidence. Nonetheless, confidence is still at extremely low levels. I would say a growing sense of pessimism that's taken root in the European economy. So, this is going to hit both the supply and the demand side of the equation, and likely means that growth in Europe, even if we get some upswing, growth in Europe really comes to a complete standstill in the context of this higher price environment. So Europe's in a bit of a bad spot right now. We expect growth in Europe to, as I say, pretty much come to a standstill, stay essentially flat through this year, with the balance of risks very much tilted to the downside should Putin decide to fully turn off the natural gas taps. And this is a bit of the risk, the tail risk around what does a cornered Putin look like, right? With no off-ramp for Putin. At what point does he explore this policy, this scorched earth policy, where, for now still needs the money to fund the war, but at a certain point, there is the risk that he decides to completely shut off the taps to energy completely. And obviously that for us presents a downside risk, significant downside risk, in particular for the European market. I will say at this point that a full reopening of the Chinese economy remains a rare upside risk to our forecast, but that's got to be weighed a bit against any potential negative epidemiological consequences that an early reopening in China might bring. And so certainly something that we're keeping an eye on, but we're balancing our excitement, our exuberance around a Chinese reopening against, again, any of the epidemiological consequences that might come with it. So far, we haven't seen much impact from this supposed Chinese reopening, but certainly, as I say, it's an upside risk to our forecast. Now, next slide. In contrast to Europe, the story in North America is actually not that bad, is actually looking up a little bit. Why is that? Well, the answer is sort of in that old joke about never standing between an American and a cash register, right? The answer is the U.S. consumer. That's really what's sort of keeping things afloat. Remember that the consumer, in the United States at least, came into the downturn, into the pandemic, with a whole bunch of pent-up demand already, deferred purchases for one reason or another. And while wave after wave of successive lockdowns forced the consumer in the U.S. to change their consumption patterns, right? Swapping out vacations for Amazon deliveries, restaurant dinings for Netflix accounts. It also forced the consumer to put more money away. You remember that rainy day fund I referred to at the beginning of the presentation? Well, it's a good thing that the consumer is still sitting on a whole bunch of extra cash, right? Because the skies over the US economy, the skies over the North American economy have started to cloud over a little bit, have started to turn a bit gray. And so the consumer, it's a good thing the consumer is sitting on this cash. In fact, you see here in these charts that US households are sitting on about $1.2 trillion of what we call cash on hand, right? And that acts as a bit of a buffer. That's huge. That's huge. That's a lot of money, right? That's about, that's insurance on like 3 months worth of pre-pandemic retail sales. And so with the consumer in the US accounting for, 70% of that country's overall economy, that's a lot of insurance. That's a lot of insurance. Even as government transfer payments, the housing market, net trade as a result of a stronger US dollar are expected to sort of weigh things down a little bit in the US going forward. Now, there are signs that the consumer in the US has started to pull back a little bit. Something we're watching very closely. We noticed that savings rates have started to fall back. Still high energy costs are taking a bit of a bite out of what we call discretionary spending in the United States. And so you can see that the consumer has had to run down some of those excess cash reserves. And that's represented by that dotted line, that perforated line that's moving closer to the solid line. In fact, you can see that cash on hand now is a little bit less than half of what it's been over the course of the entire pandemic. And that's, a risk to our forecast. That's something that we're keeping a very close eye on. It's something that we're recommending our customers, certainly those that have exposure to the US, direct or indirect, we're recommending that they keep a very close eye on. So while our base case forecast is still not calling for a technical recession in the United States, and I want to be very clear about this because we've been an outlier here in the market for some time now, in that we're not calling for that technical recession in the United States. Notwithstanding that, we're expecting a whole lot of nothing through this year. We expect growth in the US, and as I mentioned earlier, we're currently in the process of reviewing our forecasts, and so all these numbers are going to be updated. But for now, we're still expecting growth in the US of just 0.4%. So 0.4%. While that's not technically a recession, we're talking about a couple of basis points here, right? This is not technically a recession, but we're really talking about a couple of basis points here. What we are talking about is very weak, very uninspired, below trend growth for a US economy, lower growth in the US economy than what we're typically accustomed to, certainly lower growth than what we've seen over the last number of years. And the analogy that I'm using with our customers is, think about a bicycle that's coming to a stop. It's slowing, it's slowing, it's slowing. It's still it's still upright, but it's sort of starting to wobble a little bit, right? And even just the tiniest pebble can cause that bike to tip over. Next slide, please. One of those pebbles, potentially in the path ahead, is the labor market. Because I actually think that while a lot of people are pointing to the labor market as one of the biggest sources of strength behind the US economy, and it certainly is, I also see it as one of the biggest risks facing the US economy. Let me explain to you what I mean by that. When the pandemic hit, unemployment skyrocketed, right? So in the US, the unemployment rate, pretty much overnight, soared to 15%. Canada, we weren't far behind, but now unemployment is down to where it was before the pandemic. Right? And you see that in these progress bars here. And labor force participation is also back to pre-pandemic levels. In fact, in the United States, the participation rate is even above pre-pandemic levels. In the US now, there are almost 2 jobs for every unemployed worker. And think about that. Every worker that considers themselves to be unemployed has 2 jobs available for them. And so with demand still relatively solid, right? Consumers are sitting on all that cash. Demand still relatively solid. Companies are finding it harder and harder to not only attract, but retain the critical talent, the skilled labor that they need to meet still relatively strong customer demand going forward. And that's exactly the feedback that we're hearing from our customers. We were talking before the session earlier with Carlos. I go around the country, talk to our customers, regardless of the region, the province, the industry they're in, the segment, how big, small the company is. The number one common thread we hear is labor. There's a growing frustration out there that employment conditions have tightened so much so that anecdotally, we're hearing stories of staff leaving for opportunities in other companies doing the exact same work for up to 40, 45, 50% more money. So that's got to give you some sense of the imbalances that we're seeing in labor markets and the power shift from employer over to employee. Next slide, please. And so with inflation already at multi-decade highs and ongoing pricing pressure coming from the impacts of energy market disruptions, the impacts of the war, China's potential reopening, there's a very real risk here of falling into what economists refer to as second round effects on inflation via higher future wage growth. Let me explain to you what that means. Once inflationary expectations take hold and people expect that it's going to cost them more money to maintain the same quality of life, maybe even just improve their quality of life just a little bit, they're going to turn around and ask their bosses for more money, right? Because companies, we may report in nominal terms, but employees, consumers, we live in real terms, right? We've got to adjust for inflation. And that's what you see here on this chart. And so, by the way, if you feel poor, it's probably because you are. Now, given this power shift we just talked about, do you think businesses are in a position to reject these wage increase demands? Are you in a position to say no to your workers when they're asking for more money, for better pay? And once those wage increases go through, that's when we run the risk of falling into this inflationary cycle, right? You ask your boss for more money because it costs you more to live. He's got no choice but to give you that wage increase. Wage increase goes through. Now there's more money in the system floating around chasing the same amount of goods and services, maybe even less because of some lingering supply chain constraints. That bids prices up. Prices go up, cost you more to live. You got to ask for more money. You ask for more money, you get your wage increase, and so on and so forth. And we're seeing this happen. We're seeing this take hold in markets all around the world. I mean, the one thing that I find amazing about this is incredible about this is this sheer synchronicity with which we're seeing this happening in such diverse markets with so many different dynamics. And so next slide, please. Average hourly earnings, you can see in the United States, are up by 4.4%. Canada, it's pretty much, actually Canada, we're up, average hourly earnings are up by even more, 4.5%. And so, you know, this doesn't even cover the cost of increased prices. It doesn't even cover the cost of inflation. And it's certainly nowhere close to central bank's target range. It's not close to the Fed's preferred target range. It's not close to the Bank of Canada's target range. And so what do you think this does to expectations going forward? Both in terms of what employees are expecting to get and what employers are expecting to pay. In Canada now, more than half of employers tell us that they expect to increase wages over the next year or so. And it's why we're very concerned around rising energy and other costs, feeding through to higher wages and eventually on to core prices. Even in Europe, by the way, even in Europe, with all the dysfunction that's happening in that market, with the unemployment rate in the euro area down to historically low levels in the European context, historically low levels, there is going to be intense pressure to hike wages there as inflation is continuing to erode consumers' wealth, as we said before, and their ability to spend. So much so that Germany's largest labor union, not long ago, floated an 8.2% wage increase. 8.2% wage increase in a market that is absolutely obsessed with price stability. I find that astounding, right? And so the prospect, the possibility of falling into this inflationary cycle, and here's the risk, and here's why I believe that labor markets present a big risk for the global economy. The possibility of falling into this inflationary cycle raises the risk that central bankers have to raise interest rates more than they previously expected, more than what we previously expected, or even just stay higher for longer. And that will have grave consequences on the growth prospects that we just talked about. And even, you know, I look back in my own profession and I look at folks' interest rate forecasts going back even just over the last 3 months, 6 months, and you just see a steady, sharp increase, right? Terminal of the expected terminal rate, the so-called terminal rate of central banks, right? We keep getting it wrong. We keep thinking, well, there's no way they're going to get past 4. Well, okay, maybe just a bit past 4. Well, there's no way they're going to get past 5. Well, maybe just 5 and change. Now we're starting to talk about 6% for the Fed. Now, next slide, please. At this point, I will tell you, we don't have reason to believe that the Fed won't continue along its fairly resolute but well-managed path, interest rate path. At this point, we expect the Fed funds rate probably to peak at 5 and change, 5 1/4, at most 5 1/2. But again, we continue to increase those interest rate, those terminal rate forecasts. But we expect it to end probably at around 5 and change, hold there for a while in order to bring inflationary expectations back in line, inflationary dynamics back in line, before only being able to pull rates back down the earliest in 2024. Additionally, accelerated what we call balance sheet reductions, or what economists like to refer to as quantitative tightening, are going to have the equivalent effect of another 50 basis point increase through the course of this year. Now, the Bank of Canada, I believe I won't say much about Bank of Canada, but I will say that the Bank of Canada deserves a huge amount of credit here, a huge amount of credit. First of all, for calling this thing what it is, and that there's from the beginning, and that there's no way this thing is transitory or temporary, right? And also for being well ahead of its G7 counterparts in raising interest rates. And that, we believe, is what allowed the Bank of Canada to be a leader in terms of the downshift of rate increases, right? The bank downshifted their rate increases in January. We believe that allowed the bank the flexibility to lead on the downshift. But We expect that the bank is going to stay in lockstep with the US Federal Reserve now that it's temporarily overshot what we call its neutral rate, that rate that neither promotes or takes away from inflation. Stay there as it's expecting to do, as it's announced it will do, in order to bring inflation back in line before, again, only being able to pull rates back down. Probably in 2024, there's a possibility, there's a scenario that we envision where the bank could start to pull rates back down in the fourth quarter of this year, but the balance of risk is showing us likely only in 2024. Now, the situation in Europe is a lot more complicated because higher inflation expectations in Europe and higher inflation data that we're just receiving, that we got this morning, that we got yesterday in Europe, are adding to pressures on the European Central Bank to continue with its very aggressive monetary policy actions, certainly in the European context, despite the fact that Europe is sliding closer and closer into an economic slowdown. Also, while we know that the European Central Bank, the ECB, doesn't officially target the exchange rate, it's not lost on ECB officials in Frankfurt that higher US interest rates are leading to a depreciation of the euro, and that causes the euro area to import more inflation into the zone. So they've got to do something, right? They can't just sit on their hands. They've got to do something. It's almost, I kind of chuckle because it's almost like the currency wars that we saw in the aftermath of the global financial crisis, except this time in reverse, right? Now central banks are looking to have stronger currencies in order to be able to ward off any potential inflationary pressures. But we think that the European Central Bank is going to struggle to keep up with the US Federal Reserve, given the need to more delicately balance the impacts of the war on inflation on the one hand, with any impacts that the war is having on growth and confidence, because there are very legitimate fears, very legitimate concerns here that the ECB may be tightening on the cusp of a recession. It's the last thing a central bank wants to do is to raise interest rates, tighten interest rates as you're sliding into a recession. And so you can bet that the US Federal Reserve is watching the ECB closely. That the Bank of Canada is also probably watching the ECB pretty closely, watching the Bank of England closely, wondering whether it's looking at some future version of itself and questioning whether there's a very real risk here that it's central bankers themselves that are the ones that are pushing us into an economic slowdown. And the question for me then becomes, what do central bankers do now that it seems that interest rates are still high, or rather inflation is still high, but likely starting to fall, and unemployment is still low, but expected to start to rise? Because remember, monetary policy comes with a lag of between 12 and 18 months, right? So any interest rate increase you're doing today is only going to start to impact you in a year from now, right? At the beginning of 2024 at the earliest. So the timing here is really, really delicate for central bank officials to figure out what they want to do. So it's a really fine line that central bankers are walking here. Next slide, please. A very, very fine line indeed, because up until now, cheap money has let governments spend. Well, it lets governments borrow, which then lets governments spend. It's underpinned historic stock market valuations, abundant credit to the private sector. Since the collapse of Lehman, we had more than 1,000 global interest rate cuts, and central banks have injected more than $23 trillion into the system through various QE measures. And so a sudden change to that is going to be painful. It's going to hit equity, credit, housing markets in certain economies. Hello, Canada. Take the shine off certain commodities, lead to currency instability. And so what happens in financial markets if central bankers move too far on this thing, or even if they just stay higher for too long, right? To get back to our biking analogy, the training wheels are coming off this thing. There is no more scope for policy support anymore. And any country that tries to implement policy support is going to get hammered by markets, going to get hammered by voters. And we saw that play out in the UK over the fall, right? Higher real yields aren't only going to lead to higher borrowing costs, but they're also going to make more risky assets relatively less attractive in financial markets. And that could expose a whole bunch of over-leveraged corporates who've spent the last number of years loading up on unproductive debt beyond what's sustainable. You know, Warren Buffett used to like to say that while a rising tide raises all boats, it's only when the tide goes out that you see who is swimming without their shorts. And the tide is very much going out now. And so it's the swimming without shorts part that I'm a little bit concerned about. Next slide. Because at a global level, since before the pandemic, non-financial corporate debt jumped from $76 trillion to a phenomenal $88 trillion. $88 trillion. I mean, corporate debt now is pretty much 100% of global GDP. Think about that. Corporate debt now is the size, the debt that companies have out is the size of the entire global economy. And that suggests to me a much greater than usual corporate sensitivity to higher interest rates and presents a significant vulnerability for the global economy. Government debt, as you can see here, increased by even more than that. And that's raising concerns around some of the riskier euro area sovereigns like Italy, with a debt to GDP of 150%, which was a big beneficiary of the European Central Bank's bond buying program and historically low interest rates. And so this is going to evoke painful memories for ECB officials of the last time they raised interest rates, back in 2011, just before the region fell into a debt crisis. Higher rates in advanced economies will also lead to a reversal of capital flows out of emerging markets, many of whom came into the pandemic with elevated debt levels already, and who spent the last number of years experimenting with larger budget deficits, unconventional monetary policies. The stronger US dollar makes it more difficult for countries that have a significant share of their debt denominated in US dollars, right? It makes that debt more expensive to carry, more difficult to pay down, more expensive to pay down. In fact, there are now 14 sovereigns, 14 governments on JP Morgan's emerging market bond index with spreads above 1,000. A year ago, it was only 7. In January of 2019, it was just 5. Higher food prices, higher energy prices are another pressure point for many of these emerging market governments, where household spending on like these types of staples tend to make up a larger share of total income. And so as food insecurity, fuel insecurity grow, and regimes struggle to contain their inflationary impacts, the prospects for social unrest also increase. You don't have to look too far back into history to see examples of where higher food prices or higher energy prices have led to increases in political instability. Think about the Arab Spring, for example. And so if the global financial crisis in 2008 was an effect of Greenspan's response to the recession we never had in 2001, as many people say that it was, as Greenspan himself now says that it was, then I worry about the scale of any potential consequence to the extraordinary amount of liquidity we've been pumping into the system over the last decade. I mean, we've been doing this now for about 10 years. So next slide, please. So yeah, that's kind of how we see things, right? To say that 2022 didn't play out quite the way most of us expected would be an understatement. And again, anybody that tells you any differently probably isn't being entirely truthful with you. Inflation above 40-year highs, war in Europe, tensions in the South China Sea are only further compounding the lingering effects of a global pandemic that we're still trying to get out of. The US is going to see weak, uninspired, below trend growth this year. Even Canada, which has been fairly resilient up until now as a result of stronger commodity prices, is expected to join the US on this, what we'll call this lower growth track. Europe, the UK, meanwhile, is in for a bit of a rougher ride, right? Thanks to surging energy costs, declining consumer purchasing power, impacts on business pessimism. While the Chinese government is leaning heavily into its economy, and other developing economies are struggling with the cost of food, the cost of fuel, simmering social tensions, deteriorating debt dynamics in the context of an increasingly tight global credit environment. And so if you throw all that together, we get global growth falling from what was probably about 2.5% last year, falling down to, as you can see here, 2.3% in 2023. So while we believe that the global economy manages to sidestep a recession, and I'm going to repeat that, we do believe that the global economy manages to sidestep a recession, it's not going to be the case for all markets. What's more is that if not a recession, it sure might feel like one for many companies who are going to have a harder time passing on higher costs to their customers, right? Global growth with a 2 handle, if not recessionary, is pretty darn close. That's about as close as you get, right? That bicycle is moving really, really slowly. It's still upright, but it's really starting to wobble. And the path ahead is absolutely littered with pebbles. Slowing consumer demand, specifically out of North America, and in particular out of the US economy, the driver of the global economy. Russia deciding it's going to fully turn off the natural gas taps. Central banks moving too far too fast or even staying higher for longer than they need to. Financial market contagion, asset repricing, corporate sovereign debt default, simmering social tensions, right? Social unrest. All other tail risks, sure. We have Iran, we have Taiwan. Again, as I mentioned before, what does a cornered Putin look like? And what does that do to the global economy? So the downside risks are significant. And this is reflected in what I'll say is the relatively low weight that we've assigned to our base case forecast. Probably about as low a weight as you can assign a base case and still call it your base case. I think we have it now at about 65%. In fact, if we run what we call a scenario weighted forecast, then you do get recession in the US in a number of systemically important markets like Brazil, Mexico. So what does all this mean for the Canadian economy, for Canadian companies? Well, all this volatility has obviously complicated the operating environment for a good portion of our economy. Generally, Canadians will face headwinds as credit conditions tighten. As interest rate hikes flow through, we expect to see a gradual weakening of Canada's domestic economy. But in that context, trade will be more important than ever to help drive Canadian growth, to help drive wealth creation in our country. Commodity exporters are generally still benefiting from tight global supplies, and prices have come down, but historically high prices across much of the commodities complex. As countries look for energy security, for example, and renewable energy at that. The current geopolitical context offers some opportunity for growth for Canadian companies. Agricultural exporters, likewise, we believe will remain critical to feeding the world as long as the war in Ukraine continues, and likely even beyond that, because of a number of structural constraints that the global economy is facing on the food side of things. While transport and logistics constraints have really prevented a lot of agricultural exporters from realizing the full benefits over the last little while, together with higher input costs, transport costs are coming down, input costs are coming down. And so we expect some ag exporters to benefit from that. Additionally, crop exporters are benefiting from the fact that we had a record yield this past harvest season. Demand for wood products, meanwhile, we expect will likely weaken as consumer spending increasingly rotates away from goods back towards experiences or services, and higher interest rates take a bite out of residential investment. That's also going to be the case for exporters of manufactured goods, who are also having to contend with tightness in the labor markets and more narrow margins. Now, for other sectors like autos, aerospace, tourism-dependent sectors, conditions are actually improving in a post-COVID world. And so while the reasons may vary, there are some sectors that are positioned for opportunities, but you need to keep your eyes on those pebbles, right? And what that means to me is that in this age of increased uncertainty, we need to spend more time thinking about scenarios, risk-weighted forecasts, thinking through the what ifs. And so, for example, if your downside scenario carries with it a probability, a weight of 30%, you should be spending 30% of your time thinking that through, right? What does that mean for my strategy? What does that mean for my balance sheet? What does it mean for the balance sheet of my customers? At the same time, you need to make sure that your capacity can keep up so that you're able to answer the door if and certainly when opportunity comes knocking. So cost cuts, yes, but also a decrease in financial leverage and an increase in investment in order to grab market share. Invest in your plant, property, and equipment. Invest in your people. Invest in what it is that makes your business grow, what makes your business run. And that, we believe, will give those companies the competitive edge that they need to not only withstand, to meet the challenges that are no doubt in front of us, but also take advantage of the opportunities that we see coming as the global economic cycle starts to turn towards the end of this year and as we head into 2024. So I'm going to stop it there. I see that there are already questions sort of popping up, so happy to answer any questions or kind of do it, figure out, sort of what you want to do with this at this point, Carlos. Thank you.
Okay, so thank you very much, Stuart. Really, really interesting presentation. Before I read out the questions, I've got a couple of things to ask. Okay, so for those who just joined us and for those who've been listening to the presentation and would like to ask Stuart some questions. We do have a chat box, so my suggestion is click on the chat box and input your question, and I'll read out the question to Stuart. So feel free to do so now. And before he does so, I will ask a couple questions. One question I've got is, you had mentioned that in the States, there's currently two, for those, the unemployed population, there's 2 jobs per unemployed available, right? What kind of jobs are those? Like, what kind of jobs are those?
So, I mean, it tends to be where we have sort of more jobs available, tend to be kind of on the services side of things, because, I mean, that's a little bit of, the talk around, while we may not get a recession, we may start to see a rolling recession. So recessions that roll through certain industries, not all industries are going to be experiencing similar things. And so while we may see, for example, the tech sector being harder hit, where we are starting to see upward demand is as consumers start to rotate their spending away from goods into services. So we start to see some demand on the services side. And so an uplift in the service side of things, while goods may take a bit of a hit, certainly on the tech side, things like remote work, these types of companies are taking a bit of a hit, but jobs being available in services, in tourism, for example. So it depends sector by sector, but yeah, you're right. It tends to be sort of clumpy if you look at certain sectors. And I'll say also certain experience levels. And we were talking again before the session that what we are starting to see is, if you look at the cohorts, the age cohorts of those who've left the workforce, we started to see a bigger chunk of the older cohort leave the workforce. Those people, because as a result of their nest egg, perhaps asset prices being elevated, decided at a certain point, I'm good, thanks very much, time for me to retire, take an early retirement. These people have exited the workforce. And so there is we start to see the dearth of labor supply at the older, more experienced end of the range, rather than sort of at the younger end of the range. But I think that's a great question.
Okay. And a follow-up question to that is that you had mentioned about skilled labor, right? And the fact that these days people have choice when it comes to employment opportunities, right? They can go somewhere else and get 40 to 50% more than what they're making. How do you attract if you're employed? How do you attract skilled labor in that kind of context? Because obviously you cannot just randomly choose somebody off the street. Like, how do you attract skilled labor if you are not in a position to be able to increase the salaries to that level?
Yeah. So I think there's a number of potential solutions here, and we can go on as long as you'd like to, because this is a big topic, and this is probably a topic for a separate webinar. But many Canadians complain that our education system doesn't produce the right mix of graduates, and I think that while the link between schools and employers has vastly improved over the last little while, more can certainly be done on the education side to put out the right, the right types of graduates that our companies really need to see. I think there are other potential ways to start attracting labor. One thing that we notice is that, for example, other countries are leveraging digital communication, remote work, as a way of importing labor from Canada without physically moving people. And in some cases paying a lot more for it. And I think, we can and should be playing the exact same game. There's other ways to import labor without physically moving people. And here I'm talking about, investing in production facilities abroad, in companies that have a surplus of labor, in countries rather that have a surplus of labor capacity. It's a risky proposition. It's not as relevant in all industries, but our data tells us that companies that have these foreign subsidiaries abroad tend to, on average, outperform the companies that don't. Speaking of remote work, flexibility is a big issue for employees these days. The older workers with a ton of corporate memory are maybe looking forward to retirement, especially after their COVID experience. The younger set are coming to market already with heightened expectations around remote work. And then, linked to that, I'll also say that you need to ensure you have the right culture to attract, retain, and develop a diverse workforce. And in order to do that, you need to understand what the employees of today want. And maybe not just the employees of today, but also the employees of tomorrow, right? If you think about it, Gen Z, millennials, Gen Z is about a third of the global population. Millennials, that's probably another third. Increasingly, this new generation of workers is looking to work for organizations that reflect their values. They believe in sustainable business, responsible business, the inclusive workplaces. There was a Deloitte study that was put together not too long ago that suggested that 60% of millennials chose their current employer because of its purpose. A further 78% said that purpose would be the reason for them to choose their next employer. So you need to be thinking about that in the context of this, intense global competition that we're seeing for skilled labor. So these are some of the answers, some of the things that we need to be thinking about.
Wonderful. Okay, so I'm going to read out a few questions that we just received. First one is with regards to your presentation slides. Loved it as per this individual. Will they be available? And
Sure.
I believe so. So I'm after the Q&A, I'll show you where exactly people can access not only the video but also the slides. So bear with me for a few minutes, and I'll definitely show you on our CIM MES website where you'll have access to not only Stuart's presentation and slides, but also past MES events. Okay, so that's that. Okay, so I've got another question. And first, it's a comment and then a question. The disruption of supply chains and trading patterns played a large part in the volatility of the last couple of years. Do you see the changes, Roth, as permanent or semi-permanent, or will we drift back to old trade patterns over the next few years?
So sorry, you're just cutting out a little bit. The disruptions of?
Okay, so the question is that, okay, I'll reread it again.
Yep.
The disruption of supply chains and trading patterns played a large part in the volatility of the last couple of years. Do you see the changes as permanent or semi-permanent, or will we drift back to the old trade patterns of the next few years, over the next few years? Sorry.
Okay. So this is probably after labor. This is the second most popular question that we hear. And this is basically a question that goes to the heart of globalization. And the future of globalization, the future of supply chains. And often people refer to it as reshoring, onshoring, nearshoring, friendshoring. All these are like kind of cutesy terms that basically describe deglobalization. So first of all, I will say, I'm not that old, but I'm old enough to know that every time the global economy runs into trouble, we start to hear these echoes of, globalization being in retreat. And we heard it through the global financial crisis. We certainly heard it through, through 9/11, that short period of time over 9/11. But here's my thinking on this. The quest for profit maximization in a free market make global supply chains an inevitability over the long run, and globalization unlikely to reverse course, barring massive changes to the global trade paradigm. And we've seen some pretty big changes over the last little while. Because as long as one company benefits from sourcing its factors of production at their lowest cost, others have to follow, right? And so additionally, I will say that restructuring these complex production systems that are spread across multiple countries and multiple continents in some cases takes time and takes money, lots of money, and may not actually yield the most effective outcomes. So from a company perspective, we don't actually see that the incentive is there to fully turn away from globalization. We just feel the gravitational pull of globalization is too strong, again, in this kind of in a free market where we're incented to produce at the lowest cost and sell for the highest price. Additionally, I will say from the government's perspective, the IMF has put together a number of studies on this, and they show that no matter the study, no matter the shock that they impose, whether it's kind of a typical trade shock, like policy uncertainty, trade policy uncertainty, or like a total fragmentation scenario where you have the world split in two along the lines of the UN General Assembly vote condemning the Russia's invasion of Ukraine. No matter the scenario they impose, we see big losses to the global economy in terms of GDP, in terms of jobs, in terms of investment. And so governments don't actually I don't believe, have the incentive to turn away from globalization. I think more likely what we're going to see is globalization adapting in order to stay alive. And this is going to have a more nuanced impact on global trade, right? Maybe we're going to be looking at regionalization versus globalization. But I don't see this as a deglobalizing. I see it more as a de-risking, if you will. So, reassessment of strategic industries. So, PPE, other medical supplies, that came up during COVID. So maybe we start to de-risk the supply chains around that. Trade infrastructure, critical industrial technologies like chips, another big issue. And so we're bringing some of that production onshore, along with, of course, the old standards like military technologies, energy infrastructure. But, we are starting to see companies prepare themselves. I think that companies are really looking at new supply chain risk management practices. So again, it's a matter of de-risking, not deglobalizing. So we're seeing, for example, companies moving to away from just-in-time delivery to just-in-case inventory, shifting to multiple sources of raw materials, so dual sourcing. So again, while supply chain management in the past was really about cutting costs, now companies are thinking more about balancing sort of the competing interests of, yes, cutting costs, but improving your resilience, cutting your carbon emissions. So there's other factors at play here. But again, I just don't see this deglobalizing as a long-term solution. I just don't see that being where we go.
And I know you touched upon this, but there was a second part to this question is, are we segmenting into two world trading blocks with only modest trade between them?
Again, well, it's a typical economic answer, right? In the long run, we're all dead. But in the long run, no, I don't see it, right? I looked to that IMF study that was done not long ago around this total fragmentation. So either cutting the world in two along the lines of the UN General Assembly vote back in March of 2020 or 2022 rather, or in sectors that have recently seen an increase in restrictions like energy, technology, and where sort of these non-tariff barriers in other sectors are being put up, back to kind of Cold War era levels. We see that the IMF predicts that as a result of those types of policies, global annual losses at 1.5% of GDP. And the losses tend to be larger in countries where, the trade with the other bloc is significant. And so, if you think about the big players these days, the US, China, trade is pretty significant and pretty significant share of kind of the of industry. So again, I just don't see governments having the incentive. I think it plays well politically. And so it makes sense that you're going to see a lot of this noise in the short term, hear a lot of this noise in the short term in response, plays well along the electoral cycle. Longer term, I just don't see it being sustainable to completely turn away from globalization. If you look back over the course of history, globalization has only really moved in one way. The world is getting smaller. Progress is never a straight line. It will jump around back and forth, but ultimately we're headed in that one direction. That's my view.
Okay, great. And so one last question. The economy is shifting with respect to accelerating decarbonization of the economy, move to net zero, plus adoption of broader sustainability. Can you comment in general how this is captured or forecasted in the macro economy, especially for the mining industry and the push for the production of critical minerals?
Sure. We very much believe that this is the future of where the economy is going. What does it mean? Well, it necessarily means a redistribution of income between sectors, in some cases between countries. Although, for a country like Canada, where we have a wealth of kind of these sort of traditional sources of energy and mining, we also conversely we are a source of many of these transition metals and minerals, right? And we are sort of, I would say, we were saying before the session, the cutting edge in terms of our processes with, our ESG processes with respect to, consultation with Indigenous communities and environmental practices. And so I think for Canada, we're actually very well placed when it comes to that, notwithstanding that we depend as heavily as we do on oil and gas and on mining. I think that actually gives us a bit of a competitive advantage. But it is the direction of the global economy. It is the evolution. It's where we're headed as a global economy. And it's a risk certainly for some companies, for some industries. But, you know, we've got to get used to it. I mean, this is where the world is headed. It's where consumer preferences are taking us, taking the economy. It's where regulation is taking the economy. And so I think to deny it just increases the risk. That's our view.
Okay. And you did before this presentation started, you mentioned that there are some typical questions people ask you, right? Are there any that you wanted to highlight that wasn't asked today?
Well, I mean, you know, the labor one is a big one. Globalization is a big one. You know, we do get quite a bit on the ESG side of things, though again, it depends on the audience. But no, I think we pretty much covered the waterfront there.
Wonderful. Okay, so what I'm going to do now, because people ask, so bear with me for 2 seconds. Okay, so sometimes this is okay. Share. Okay, so the question that was asked is, where can you access Stuart's presentation and also the actual video itself? If you go onto our MES website, okay, and you go here, national, okay, you will see on the right-hand side, you will see this menu, right? And here you see highlights from past CIM MES events, okay? What we do is we capture all past events here, right? So if you want to access either the videos or the slides itself, you will be able to access them here. So we go back literally years, and not only 2000, but if you go to specific chapters of MES, that we've got the similar structure, and you'll see past events there. So right here you will see Stuart's video and also presentation slides in the coming days. So do join us on this website, and you'll find them here. If you're new to MES and you're interested in getting announcements of future events, by all means, I encourage you to go to here, stay connected, right, and subscribe to our MES mailing list, and we will definitely give you a heads up as to upcoming events. We do not sell your information to anybody. We do not give it to anybody. So all the email addresses that we provide, that we get access to, we just share upcoming events. We don't sell them. So so in other words, don't be shy to share us your details, and we'll definitely give you, heads up as to future events. Our next event is going to be March 29, and it's right here, right? And it's entitled "Security and Liability: How to Reduce Risk when Deployed Overseas." You'll get notification of this event in the upcoming weeks, and so do join us then on March 29. So this concludes our event, so bear with me for 2 seconds. I'm going to share something else. Okay, share screen. Okay, so we want to thank you. Okay, first we want to thank Stuart. Okay, so thank you, Stuart, for today's presentation. We always enjoy having EDC present to us. We do this at least once a year, and every year it's always a hit. So thank you very much, Stuart, for keeping up the tradition. We also want to thank EDC for their active involvement within MES. Literally, I would say at least since I've been involved with CIM, but I would say at least 15 years. So thank you to EDC. We want to thank you, the audience. Okay. And we definitely want to thank our sponsor, IM Gold. But one thing to keep in mind is this, okay? MES is not us. I mean, it's not us in terms of me, okay? It's us in terms of you. So in other words, if you have an interest in future events, and if you have interest, and if you know of any good guest speakers, by all means, do let us know, because we're always interested in new events. We're always interested in featuring new speakers. So shoot us an email at info@cimmes.org, and we'd love to hear from you. So this concludes today's event. Thank you very much. Thank you, Stuart. Thank you, EDC, and thank you. And we'll see you again soon. Take care.
Thank you.
Bye-bye.
Thank you, Carlos. Thank you, Jackie.